Do you have any thoughts on Austin?
I mean, this was just a case of our jaws dropping. You and I have been doing this for, close to 15 years together at this point. And this IPO stands out in my mind as one of the craziest. You are listening to the AI Investor Podcast from 24/7 Wall Street. On today's episode, we look at earnings, an update to the portfolio, and Eric's hunt for the next great AI YOLO investment. All that and more is next. Eric, happy earnings season. Basketball fans have March Madness and they only get it once a year. We tech investors get our own March Madness 4 times a year. And what a beautiful time of year it is. We are deep into earnings season. There's some heartache. There's some jubilation. Some of the earnings movements we've seen harken back to some of the 2021 volatility we saw at tech stocks. I know you were up very late the last few nights digesting the news, but what are you seeing out there?
Yeah, it's been very good in general. We've seen some really good earnings that we'll get into. I was reminded of this scene from Seinfeld where Kramer lights a cigarette, pops a whole beer at once, and he says, "Here's to feeling good all the time." And that's kind of what it feels like, Austin. It's just like everything has been going right for the most part until we get to today a little bit. So let's just break down kind of general market sentiment, and then we'll kind of tee up what's going on with earnings season. So what's going on today is that as we film this, Friday, August 1st, the market is down about 2%. What are we seeing? Well, we are seeing, number one, the reintroduction of tariffs. I think everyone listening is well aware how that can impact the broader market. We have seen this show before. We've warned people this is going to be a continuing storyline. That's playing out right now. The second thing we're seeing has been a lot of general froth. Yesterday, the big news on Thursday was Figma's IPO. Austin, you were watching this. We were talking at the time. Absolutely incredible. Do you have any thoughts on Austin?
I mean, this was just a case of our jaws dropping. You and I have been doing this for, close to 15 years together at this point. And this IPO stands out in my mind as one of the craziest. So they were up 250% in a single day. And this was after they already raised their IPO price. So if you actually do that based on what they were originally floated to be sold at, it's up like 300 or 400%. And then pre-market, it was up another 24-ish%. Yep. This company's trading for 71 times sales. We had talked a little bit about this in our last episode, how some of the price to sales multiples are bordering on the crazy. Now, Figma's a fantastic company with a fantastic product, but 71 times sales is, it's a little spicy on the valuation meter. But yeah, what I'm seeing is just an incredible pent-up demand for an IPO of a quality company at any price. And the at any price is the challenge. Figma's a great company with a wonderful product, but the at any price aspect of this IPO had me leaning back in my chair. I'm not sure if you had any thoughts on it.
Yeah, it's definitely very bullish for the upcoming wave of IPOs. 7 of the 10 largest private companies in the world right now are AI companies or strongly related to AI. That's probably going to be a big catalyst in the back half of the year. We saw earlier this year, CoreWeave, which heading into its IPO had horribly negative sentiment. It's up 167% since. So we'll talk about that a little bit more. But Austin, what I'm seeing in earnings season, the biggest... As we've said before, what is the strongest force in the known universe?
Well, it's the American consumer, but I think there's another major economic predator out there on the horizon right now.
Yes. T-Rex of economic predators is brewing. But yes, the American consumer, we will buy any crap that's released. If you go into Five Below or any store, it's a testament to what the American consumer can do. We will spend into any debt possible. We will take any means to keep buying whatever the world will pump out. So it is rather amazing that we had GDP released this week, 3% GDP growth, largely driven by kind of the tariff situation with fewer imports into the country. But what we saw was AI spending actually eclipsed the American consumer in the latest 2 quarters. AI spending is now generating about 1% of GDP growth. Consumer spending is at 0.65. And Austin, we are seeing that in earnings season. So this is what we're going to talk about today. Some of the results from this earnings season show a real inflection point. We've been talking about in recent episodes of the show. Now we're seeing in the numbers. So we're going to break that down. There's good, there's some bad, but what we are seeing is definitively an inflection point. So let's get started with talking about earnings because we are really in the teeth of earnings season.
Absolutely. Let's go. And I know you're going to help us unpack this, but one of the things that's been banging around in my head in the last 72 hours is, we have American consumer companies that are exposed to American consumer and AI spending. There are very few. Amazon and Meta are two of them, very much American consumers translating into ad dollars for both Meta and Amazon, but very divergent earnings stories. So anyway, let's get into it. Microsoft and Meta on the positive side of earnings absolutely blew out expectations. I mean, Meta up, I think I saw 12% the day after earnings, absolutely smashed it. Microsoft up 6 or 7. I forget where they landed. What was it that made people stand out or made these earnings stand out? Microsoft earnings, Azure for sure, but then we see Amazon had some weakness on AWS. So it's not that all cloud seems to be receiving the same treatment in the markets right now. And is the difference just GPT and Azure's exposure to that compute stack? Talk to us about what you saw.
Yeah, so let's kind of break this down because there's a lot going on. I think July 30th, when Meta and Microsoft both announced earnings at the same time, could be really remembered as a turning point. We've had these inflection points since ChatGPT came out in late 2022. And last night was one of those nights that whatever your expectations were, and ours are very high on this show, they were surpassed. And it kind of shows a new wave that's going to happen in the AI market. So what did both these companies announce? They were earnings that are almost impossibly good. On Microsoft's side, it's acceleration in cloud revenue driven by AI demand. And on Meta side, it's more revenue to the business than anyone kind of thought possible. And they're kind of taking the next step in Austin. We talked about last week with what Zuckerberg's doing this all in. It is the next kind of step there and that all in kind of moment from Meta. So Microsoft, their earnings, let's look at them first. The headline figure, it's an absolute blowout for Azure, which is their cloud computing division. Wall Street was expecting 34% growth. They delivered 39% growth. They said that they could still grow faster. They just don't have enough capacity. And Austin, we're always talking about what are these companies going to be spending going forward? Microsoft, if you go back and listen to the show earlier this year, it was kind of the question mark. A lot of people thought they were going to decrease spending. They were canceling some contracts. Well, they're taking spending up to $120 billion run rate. That's $30 billion next quarter. Wall Street expectations head into this earnings report were $18 billion. So Austin, that just goes to our companies downstream. And let's just put this in context right now, because I've got the numbers for all the major cloud computing companies. When we started this podcast last August, the forward-looking expectations were that the cloud computing companies would spend $238 billion across the next year. That's revenue that flows to NVIDIA, Broadcom, the data center plays that we've bought for this portfolio. Well, where are we at now? Google just said they expect revenue this year to rise to $85 billion. Next year will be even higher. Microsoft, I just noted, a $120 billion run rate. Meta, which we'll get into, in their earnings gave, it's not guidance, but they intimated that next year they'll be spending more than $100 billion. Amazon is now a $120 billion run rate. Austin, we add all these up plus Oracle, that's over $450 billion. So the numbers are, since we started this podcast, the question was on Wall Street, will spending go down next year? The forward projections are now up 90%. So of course, the companies that we're buying in this have much better prospects. And then we need to throw in other areas like CoreWeave and these smaller upstarts and this national spending. So, Austin, that's what we saw from Microsoft is just the next acceleration in this cloud trend. I want to pause here. I'm going to get to Meta next, but I wanted to see if you had any follow-ups or questions from that.
Yeah, well, I just wanted to put some of this Azure growth into context and how impressive this acceleration is. 39% growth when in Q2 of 2023, Azure was growing at only 27%, which was a phenomenal number for a mature business. So we've picked up 12 percentage of growth, 12 points of growth percentage in just since Q2 of 23, appearing to be accelerating even further. And one of the things that I just keeps ringing in my head as we're talking about these numbers of, roughly $500 billion going into CapEx just from the hyperscalers here, approximately, is the infrastructure to support it. And this is where you've put part of the portfolio: interconnects, cooling, power delivery, power generation, all of that money. A huge percent of that money is going to go to chips. That's obvious. And you have a position in NVIDIA and Broadcom. But there's this whole universe of additional opportunities that is needed to support those chips, right? You need the data centers, you need the cooling, you need the power, you need the cabling. And those are small companies. When you're talking about 500 billion, relatively, when you're talking about $500 billion rolling through in the next 12 months, hitting those companies, we're looking at multiples of their top line growing.
Yeah, and the crazy thing is so many of these companies were off 50% post DeepSeek, right? So they've now basically recovered to these levels. But again, they've recovered to levels that they were in off in January. But expectations have gone up another 50%. So there continues to be opportunity. Let's look at Meta as well for a second, Austin. They were the other company with impossibly good results. These companies, as you just mentioned, they are so big. If you are Amazon, there's a problem. Everyone on the planet is using your services. So how'd you get out? How'd you keep growing? Well, you use AI. The company, they grew ad impressions by 11% last quarter. The average price per ad up 9%. And what did that equal to? Equal to earnings that beat by 22%. Austin, when you're the size of Meta, beating earnings by 22% is borderline impossible. But again, it is because of this transformative company bet on AI. Essentially, Meta had a problem that Google knows your exact intent. They know what you're searching. They're able to serve ads on that. Meta does not know users' intent. Close the gap through AI. Advertising is one of the first industries that's a truly killer application for AI. We see it in Meta and how they've been able to get this acceleration no one expected years ago. We see this in AppLovin, which we've talked about, up 40x since the beginning of 2023 because they kind of staked their future into this. And we've made our bend. The portfolio with Unity as a company that was behind is now going all into AI and we believe has substantial upside. And the stock has been doing quite well. So, Austin, that's the picture with this quarter. The bigger picture, as we previewed earlier, just last week we talked about, you gave the numbers. They're astounding. Their new data center is going to require slightly less power than New York City, right? And coming into this earnings, Zuckerberg, he said that they're going to have similar growth that they did this year in capital expenditures to next year. They're going to spend around $70 billion this year. That implies more than $100 billion next year. And why this is such an all-in, if Microsoft's spending $120 billion, if Amazon's spending $120 billion, if Google's spending $85 and probably even more next year, they run it out. Meta's using all of it, right? Meta is using all of it internally. So before Meta's earnings, Austin, I'm going to read the quote here. Zuckerberg issued a memo and he said, "Over the last few months, we have begun to see glimpses of our AI systems improving themselves. The improvement is slow for now, but undeniable. Developing superintelligence is now in sight. It seems clear that in the coming years, AI will improve all our existing systems and enable the creation and discovery of new things that aren't imaginable today." Austin, this is the ultimate bull case for AI, and it's happening today. Recursive self-improvement, AI systems that are able to improve themselves. We've been talking about it on this show. I don't think a lot of people are talking about. We've been talking about it on this show since last December, saying this is what ignites the ultimate bull rally, and we now see a company going all in. So, Austin, this earnings season, we see two things. We see real AI demand happening, which is via Microsoft and growth of the Azure platform. We see AI fundamentally changing one of the biggest businesses in the world, which everyone says, what's the real world thing? Where is AI happening? Well, look at Meta's results. And now we see this moving forward thing of this is where AI either becomes a bubble or the most transformative event in human history, which is this race for super intelligence, and it's game on. It's game on. So I don't know what you can say except, again, this is a step change. This is a historic day. You look back at July 30th as maybe the beginning of a new era, and the risks are rising. Again, that this could be significant overspend. But all these companies right now, they're all in, usage is accelerating, and we're seeing real world changes.
I love the inflection point moment, and I'll actually go a little bit further and sort of fractal this down a little bit. Probably an inflection point for the technology and Earth as we approach super intelligence. Also, maybe an inflection point where we're seeing some separation between winners and losers and different approaches starting to be rewarded in one way, and having more economic reward than others. So everybody's been in this AI race, and it's seemed like every couple of weeks there was a new front runner. But now we are really starting to see some consistent winners. Amazon, at least as of this most recent earnings call, looks to be on the wrong side of that. Amazon does have AWS, and they compete with Azure and Google Cloud. Azure's growth getting very much rewarded by Wall Street. Amazon's earnings getting punished. Company is down 8% as of this filming today. Now, Amazon is more than just AWS, but in the context of this portfolio and the technology we're talking about, AWS is what we're going to be paying attention to. What's going on here? Why is Microsoft getting rewarded in this environment and AWS is not? Is it simply that Azure has GPT tokens? Is that all it is, or is there more?
Austin, you're kind of bumming me out, right? We're talking about Microsoft, Meta, these incredible earnings, and now we have to go to Amazon. What a bummer. But yeah, no, there is something deeply interesting here, and as longtime listeners of the show will note, we bought 100K of Amazon, 100K of Meta. We said we would sell down these positions, but we were kind of parking it as a hedge with the hyperscalers against spend. So the moment, I think, after these earnings is coming where we're going to announce a sell that we are going to remove $50,000 of Amazon. That's partially due to some factors we're seeing in these earnings. So as you know, Amazon's down. It was down 8% overnight. I think it is clawing back some gains as the market progresses on Friday. A few things to note. Number one, a really bad conference call from Amazon CEO Andy Jassy. You almost never see this, but as he was answering this really fumbling kind of response about whether they're falling behind Microsoft, you could see the stock tick down, tick down, tick down, tick down. It went down almost 4% during one of his answers. I'm reminded of the Billy Madison quote around that was the most incoherent, rambling answer ever. It kind of went nowhere, and you could see the market losing confidence in him as he spoke. So, Austin, if we're talking numbers, you've done a good job describing Microsoft and Azure's growth rates. They were at 31% 2 quarters ago. They're at 39% this most recent quarter. What did Amazon do in that same period? They went from 16.9% growth to 17.5%. So that's 8 percentage points of growth from Microsoft, less than 1% for Amazon. If you're an Amazon investor, that is a big problem. So there's a couple reasons Amazon's losing market share. Number one, Microsoft, they are kind of in the process of a breakup with OpenAI, but for now, they get all that OpenAI demand. That provides a huge catalyst. Second, when you look at Amazon's other rival, which is Google, Google really went out of their way to court cloud companies kind of at the outset of this mega trend back in 2023, and they got a very strong group of AI companies on Google Cloud. That's just Amazon asleep at the wheel a little bit, and they're now paying for it. I want to bring up one other factor, though. If we look at data on who's buying NVIDIA GPUs, and this is from venture capitalist Coatue, they have right now, Google in 2025, 19% market share, buying 20% NVIDIA GPUs. Microsoft at 30% market share, buying 30% NVIDIA GPUs. Amazon at 44% of total cloud market share, buying 20%. So one of these companies is not investing in the primary resource end customers want, which is NVIDIA GPUs. Even if that figure is slightly off, it is directionally such a big number, you cannot ignore it. So the short answer, Austin, it seems like Amazon's dropped the ball several ways. They didn't court the right customers, and they're not investing in the right infrastructure that their customers want. Long term, I think they're going to be fine. Their ad business is actually doing pretty good. Their e-commerce business is doing great. I think as far as robotics is concerned, almost no company has the gains that Amazon will see. Like, it can fundamentally transform their entire cost structure. But as I note in the near term, this is a problem. I think there's a chance Amazon can close these rates potentially as we move from a lot of these training as a high percentage of revenue that's coming to these cloud companies and moving more towards inference. They can close the gap. But for us, if I'm looking to sell either that 100K Meta position or Amazon at 100K, right now I would like to sell Amazon. So we're going to sell 50K of that. We're going to use that capital and we're going to have it to buy our plays in these areas like agentic AI and robotics in the coming episodes. So, Austin, I think it is kind of an issue, and you do wonder, right? If Andy Jassy, he comes from AWS, if this is the market that they are falling behind in, if he is giving rambling, coherent answers that causes Amazon to lose $100 billion in a conference call, at what point is Bezos going to say, I need to get back off my yacht and get back into day-to-day operations?
I've heard some other people talking about that as well. I mean, we've got Howard Schultz, Bob Iger. Is Bezos next on the sort of return tour here? Still remains to be seen. How much does he feel invested in Blue Origin relative to Amazon at this point? I think Wall Street would welcome his return, despite Andy Jassy leading AWS to enormous success. But it's a platform that was largely built as like the most cost-effective, B2B platform, and not necessarily the fastest, meanest, baddest AI platform, right? Which is now what the market is rewarding. So you have this it is the low-cost service provider in a space where people want horsepower and AI and a different tech stack. And AWS has not really been built for that world, or the world that we're now in, that is now being rewarded by Wall Street.
Yeah. And again, I'm not throwing in the towel on Amazon. It's just they're looking a lot less levered to this trend. And at a really exciting point, I would just rather deploy my capital elsewhere.
Yep. Well, that's big news. That is the first sell in the portfolio. We did allude to that in the last two episodes. I will expect there'll be more in the next few weeks, but we've got $50,000 coming off the table here to redeploy into new positions. Let's keep the earnings train going because it is Earningspalooza, Eric. That is our job here. I want to talk about Vertiv, ServiceNow, and Cloudflare. You and I were texting a little bit about Cloudflare, so I'm curious to hear your thoughts there. Start with whichever one you want, but I was surprised to see Cloudflare actually pop after earnings up about 7% and then give it all back, and I think they ended up down 2% or so. Pretty big swing for one of the companies at a unique, almost monopolistic position in the future of AI. So I'm curious, really, I want to hear all of your thoughts, but the Cloudflare changing tune in just a couple hours was interesting to me. But what are you seeing? Let's start wherever you want.
Yeah. So first of all, we've been talking about this before. If you go to 247wallstreet.com, we are hosting more than 300 live earnings events during this earnings season. I was watching every single company I'll talk about. I posted towards a live blog. You can see our thoughts in real time. I think if you are following companies, it has to be your primary resource going forward. If you're listening to this podcast, we are making significant investments here. So let's talk about Vertiv first. For each of these companies, I'll just make one key point because we've got a lot of companies to cover. I think it just shows their earnings show there's still a lot of upside in these AI infrastructure plays. Vertiv, the headline figure, they're now projecting full year revenue of about $10 billion. That's a big jump. They were previously more on $9.5 billion on the high end. A lot of companies, Austin, in this infrastructure space have been winners during this earnings season. Celestica is a company we've talked about a lot on the show. I wish I had purchased it. I personally own it, but we do not have it in the portfolio. They were up, I believe, 20% the day after earnings. We are seeing significant acceleration in the share price of companies like Credo, Fabrinet, the most advantaged companies in this infrastructure build out. And Austin, the reason is because these new data centers, when we talk about all these, we talked about that figure earlier, $450 billion in CapEx. that is not equally distributed. Some companies are bigger than others, and we are seeing increasingly high spend in the most advantaged areas, things like faster data transmission, things like cooling, things like a lot of the power supply services. Vertiv's a winner in cooling and also a lot of these power supply services. If you're not buying Vertiv, one other stock in the portfolio, it actually dropped after earnings because they had affirmed guidance. Schneider Electric, they're booked essentially through 2030. They're a leading company for a lot of these power supply systems. They have their own cooling acquisition that they had made. This is a low risk way to be able to play the trend. Austin, I like to make recommendations that are higher risk, medium risk, lower risk. I believe Schneider is a lower risk way to get in the growth of this data center boom. Let's go to ServiceNow and Cadence Design Systems next. My key point for these two is we're starting to see some real signs of agentic AI spending, having that beginning upturn, that first kind of inflection point. ServiceNow is not in the portfolio, but we've talked about them several times. They beat earnings. The company is rebranding itself as a full stack agentic operating system for enterprise. We see the narratives beginning, Austin, in this. But, I've made the point many times on this podcast. Palantir went up 500% plus. It wasn't because they took their growth rates from 20 to 100%. They went from 20 to 35%, and they were effectively at the front of the narrative about AI growth. I think with Cadence, they also beat earnings. They have been raised, and they talked about some of the growth happening from, their agentic product suite. We're just starting to see these companies. It's not that they're going from 20 to 30% growth. It's 20 to 21. And if they keep accelerating across quarters, that's what produces those really stellar results. So I think looking at Cadence and looking at ServiceNow, it shows kind of that beginning uptrend in the revenue that's going to flow from companies that have really solid additions of kind of agentic software. Cloudflare, this is the one that... go ahead.
Eric, but just before we move on there, I wanted to throw a little bit of context around Snowflake as well. Snowflake has made some meaningful investments in agentic AI. They are in the portfolio. So if you're looking for some early agentic exposure, Snowflake is one that you've already endorsed that we think is well positioned for that narrative shift as well.
Yeah, and one more thing on Snowflake. Their primary competitor, Databricks, is likely headed for an IPO. If what we saw... If there's rabid demand for Figma, it's going to be nothing compared to Databricks, and that's going to have a significant halo effect on Snowflake itself. So that's a big catalyst.
Excellent point. Okay, sorry, on to Cloudflare.
Sure, Cloudflare. My main point on this would once their inflection point, I believe you're seeing the first kind of signs of that moving up. The company is outrageously expensive, as we've talked about on the show many times. But the potential is there for it to be the story stock of this agentic era. They took revenue up from 26.5% last quarter to 28%. They raised full year expectations. It's just exactly the game plan you need to follow. You need great narrative and you need this acceleration. So I think everything looks good. They're trumpeting. One thing we love about them is their workers development platform. They've been trumpeting having record wins on that. It just seems like they're finding growth and they're finding growth in the right places. Why did it drop? It's hard to say, Austin. I mean, expectations are very high. They did what they were expected to do with the beat and raise, but we're seeing a little bit of a sell-off today. But we also have the broader market down 2%. And any stock that's trading at 35 times this year's revenue, if we have a steep market sell-off that's putting risk first, that stock's going to sell off. So I would say if you're interested in Cloudflare, just, put it at the top of your list if there's some market sell-offs. It can be an idea that maybe is too expensive today, but like I said, the early signs of what we expect to be the long-term story are really showing signs of developing this quarter. The last stock I want to catch on for this earnings season is Lam Research. Austin, if there is an AI explosion, the number one industry you think that would benefit is kind of the picks and shovels play. The company is actually building the equipment to make the chips. They've been great investments forever. It would be logical that would flow through into the era of AI. But, if everything just kept moving up into the right, that had moved up into the right, it would be free money, right? And that's not how the stock market works. We're seeing new dynamics in this space. Essentially, the companies that are building kind of the most advanced leading edge equipment, Taiwan Semiconductor is doing great, Samsung's not doing great, and Intel's doing even worse. So they don't have quite the diversified customer base they used to have. There's geopolitical concerns. They're kind of being used as pawns in this game. And what we saw from Lam Research is excellent earnings, but its primary competitor, which is named Tokyo Electron, they pulled their guidance for sales next year and said it's a longer recovery than they expected. So Lam Research itself, great earnings, but they're just falling because of what's going on with competitors in the general space. So the big picture here, Austin, is we're just going to continue limiting our exposure to the semiconductor equipment, the people who make the machines to make the chip space, because for now it seems like it's still a very challenged area, and we'll stick with Lam Research because they seem the best of the bunch of, the big companies in the space, and we have a more specialized play in Camtech, which is focused more on the growth of some of the newer memory products. So I'm happy to keep both of those stocks. I think that covers most of our earnings. Probably not all, but most of our earnings, Austin.
Probably not all, but impressive coverage there, Eric. I'll give you a bit of a breather there. Maybe when you talk about Lam Research and some of the challenges that we see in that sector, some of it's competitive based, some of it is just outside of their control. I get echoes back to some of the conversations we had around ASML, an incredible company that has phenomenal technology that's at a essential juncture for the growth of artificial intelligence, but they've got growing unknown competition from China. And to some extent, their future feels out of their control because they get played as a geopolitical piece. So I'm not saying Lam Research and ASML are necessarily perfect analogies, but there's similar reasons here why we are not why we're not exposing ourselves to what people might say are like, the obvious plays. Like, why not just put all your portfolio in, Lam or ASML or Taiwan Semi? And here's why, right? There's factors like this beyond these companies' control that we can't see past. And when you're at a moment in history when technology is accelerating at these sort of rates, you want nothing impeding that growth. You don't want any curveballs coming in, taking you out of the game for 18 months while tariffs get negotiated, right? Because then competitors can move ahead. So that's just one of the reasons. I had some throwbacks to our prior conversations there. Let's move on to Marvell. This is one of the highest risk reward plays in the portfolio. But they've got some key partnerships, and we've talked about how much those key partnerships are spending, particularly Amazon and Microsoft. Can you talk to me a little bit about Marvell today and how they compare to other players in this space?
Yeah, if you were going to bum me out with the Amazon tee-up, Marvell, woof. Broadly speaking, the most disappointing stock in the portfolio. So I think it's worth an update, and they actually had some specific news this week, so we'll cover both. Now, as background for anyone listening, especially if you're newer, there is an opportunity around custom chips because you've got NVIDIA supplying record-breaking amounts of GPUs. The alternative for companies like an Amazon or a Google or a Microsoft is to build your own custom chips designed for AI workloads that not only gives you a differentiation factor where you can be cheaper than competitors, but it also allows you to have some leverage over NVIDIA in negotiations. So it makes a lot of sense why these companies will want custom chip programs. Now, Broadcom has soared to being worth $1.4 trillion with major partnerships with companies like Meta and Google, which is their best partnership, and OpenAI. Marvell, the bull case for them is they have partnerships with Microsoft and Amazon, but they're worth $70 billion, so about 20 times less. In addition, they have a pretty strong portfolio of all these connectivity products, things like digital signal processors and being able to connect different data centers together. So here's the news for them this week. A Wall Street firm crunched the numbers on their deal with Microsoft, and they found it will deliver, in their estimation, $2.4 billion in revenue to Marvell in 2026 and $10 to $12 billion in 2027. For perspective, Austin, right now, Wall Street expects Marvell as an entire company to generate $9.8 billion. So this one chip, this one product would be bigger than the entire current expectations. Putting this into an earnings perspective, right now, Wall Street expects somewhere in the neighborhood of $4 in profits. in 2027. This could take Marvell up past $8 to $10. So potentially 150% greater than Wall Street expectations. And I should note, if you're looking at $10 per share, what's the company trading for today? Slightly more than $70 per share. That means 7 times earnings for some of the highest growth in the portfolio. Austin, it sounds like a slam dunk. We should be backing up the truck, putting every single dollar we have into this stock. So why are we not? Right? That is the question.
Portfolio management. You're about to explain why even a perfect narrative sometimes doesn't unfold. What's
Doesn't
going
always
on?
work.
Why did you limit the position size
Well,
here?
Austin, the big thing is Marvell, the morning after this news broke, was up 11%, as you'd expect. And I said to some people who had asked me about it, I said, I bet these gains are gone within a few days. And you know what? As of this morning, they're gone within a few days. And go ahead.
I'll put the actual numbers out there. The day the news broke, Marvell was trading for 76.45 a share. Today, at the time of this recording, it's 76.20.
Yep.
So there you go. Exactly nailed
Yep.
it.
And the reason for this is Marvell had hosted an analyst day. They gave outlook and figures that basically, if you put them into a model, you have found they were set to crush Wall Street expectations. They jumped and it all fluttered away within a few days. And we just see this process happening over and over again with this company. The biggest reason, also, is just Marvell's been kind of a serial underperformer across time. They have this amazing opportunity that in some ways they've kind of lucked into, but there's an incredible amount of whispering about them performing very poorly in a lot of their portfolio and kind of the broader networking and connectivity space. And also there's always going to be risks that they have to execute. They have this deal with Microsoft, but Microsoft is trying to hedge its bets and working with other firms to try and develop chips. Will they actually get this to market? So Austin, it seems like Marvell for now is kind of star-crossed. It has the potential to rise 2-3x from where it's at today if it can fulfill on these deals, but it's going to need to execute on them. And until we see that execution happening, the street's not going to re-rate it the same way it has Broadcom, which has executed. So when it comes to Marvell, most disappointing stock in the portfolio. Fine with GitLab for that, but most disappointing stock. It's a battleground stock. We're going to leave as is despite the potential. And like I said, it is high risk, high reward. So if anyone's been looking at Marvell saying, hey, when you talked about that stock with the deal with Amazon, it sure sounded cool and it seems to be going well. What's going on? This is what's going on. And that's about the best summary I can give on Marvell.
Eric, you're going to hate me for this analogy, and I'm going to put you on the spot with a little bit of a question. But when I hear about a very promising domestic chip maker with execution risks and a serial underperformer, be forgiven for thinking you were talking about Intel instead of Marvell, right? So I'm wondering, when you see companies like Marvell, and let's just throw Intel in there as well, where there is a major movement to bring manufacturing back to the US. AI is this multi-billion-dollar race, and there's a lot of capital that's going to be flooding through there. And you and I have referenced the book Chip War in the past, and just how much domestic government or federal investment set the US chip industry on an incredible multi-decade trajectory. It feels like we might be at a similar moment where there's a lot of domestic, major infrastructure spend. Is it worth, and we're not going to do this in the portfolio, I'm sure, but is it worth investors considering like some call options on a Marvell or some call options on an Intel? Very low percent of your portfolio, but these companies that are domestic champions, serial underperformers that need a lifesaver. But if they get one, they'll re-rate very quickly. Is that a way to play these?
I feel like you're setting me up here. You're setting me up, Austin. Yeah, I own call options on Marvell, in part because of this kind of optionality where if these contracts do play out, they will be worth significantly more. And if not, in some ways, it feels low superior to buying the shares. Of course, that's dependent on, how aggressively options are priced. But no, that probably is, if you were purchasing it today, a bit of the superior play, and it just comes down to timing. Will they re-rate by the time your options expire? So if you're doing that, you'd probably want to look out to 2027 in January, because you're going to, know it's hard to get an advantage on Marvell in any short term because it is moving entirely on supply chain chatter. And that's an area where a lot of these pods and these big hedge funds have an advantage, and it's a place where the individual investor has no advantage. So, if you're holding on a thesis over a few years, you might be able to do relatively well. But if you are trying to trade the stock in the short term, it's not going to go well for you.
Mhm. Well, yeah, I promised to our listeners, I actually did not know that you held call options. So a convenient sleuthing there, but that's where my mind went. But you know what, Eric, we've talked a lot about the current portfolio, and I'm sure our listeners appreciate that. But what they appreciate even more is knowing where we're going next and what other investments we're looking at. So we are on the hunt. You said you were freeing up $50,000 of cash out of the Amazon position for our next great AI investment, YOLO. So what are some of the key themes that you are looking at? And I just want to rattle off very quickly some of the other themes, sub themes that we have talked about in prior episodes. We've talked about healthcare, we've talked about robotics, we've talked about agentic AI. Privately, you and I have talked a lot about AI in defense. So the universe of AI application and potential promising investments is vast. And I know our listeners want to know which subsectors in that space are the most appealing to you right now.
Yeah, we've been talking nothing else at the start of the podcast when we talk about the general market, except for how frothy things are feeling. So I was like, at the peak froth, I'm going to unveil Hunt for the Next YOLO. That sounds like a great idea. No, but what we're seeing right now is stocks are having a bit of a risk sell-off today. Generally, as we film this, the Nasdaq's off about 2%. So I thought it would be kind of fun to talk about some of the themes I've been looking at and some of the smaller plays. I don't know if these will necessarily make into the portfolio, but they are some of the speculative positions I've been looking at. And in the coming weeks, again, if we buy more speculative positions, we'll keep them to a very low amount. If we find companies that we think are kind of more solid and have the right risk profile, we'll add them to the portfolio. But I did want to talk about a few themes that are very interesting right now. The first theme's Neoclouds. Earlier, I talked about Amazon having that 44% market share versus buying 20% of the GPUs. Well, who is filling that gap of having less market share but getting more GPUs? That is a new breed of cloud computing companies broadly called Neoclouds. And what Neoclouds are allowed to do is they start from the ground up with an infrastructure built for AI. So the poster child for this is CoreWeave. They're up 167% since their IPO, as we've mentioned. But there's a lot of interest in other stocks in the space, such as Nebius. I might be mispronouncing that slightly. That's up 71%. The narrative on these companies has shifted. I believe what we'll see is we are seeing an opportunity for some of the companies that had been left out of the first wave of cloud computing to make an entrance with these dynamics. We've seen Oracle really rising recently after kind of getting into the cloud business late. We'll probably see most of these companies go under, but what you'll probably see is some survivors that are able to kind of find their own niche in this space. One company I was covering this week in one of our live earnings blog is Applied Digital. That's ticker symbol APLD. The headline for Applied Digital is they are certainly going for it, Austin. They are about a $2 billion company. They've been moving a lot this week, so it might be $3. It just depends how much their share price is swinging. They announced a 15-year lease agreement with CoreWeave, projected to deliver $11 billion over its term. They're breaking ground on 2 new campuses by the end of the year. So, Austin, this is a space that when CoreWeave went public, we said we're going to cover this with larger hyperscalers, but you always need to be reacting to the news. And as we see, a lot of these larger hyperscalers saying we are still supply constrained. This is going to be a persistent situation. It's going to create inroads for a lot of these companies that are smaller and have capacity of GPUs to show really strong growth rates across the coming years. Do I know what this space looks like over the next 5 years? No, but the dynamics are really attractive across the next year or two, and I can see why people are piling in. I don't know if I'm going to add any stocks into the portfolio from here. It is small and speculative, but I did want to talk about some ideas from that. So I don't know if you've got any follow-ups, or we should move to the second trend.
No, I appreciate hearing you talk about that, and I'm really excited for future episodes where maybe we learn more about the opportunity and the long-term potential because Neoclouds to me feel like they're at a unique moment in time where it's a product that only exists because of where we are at a time and place today. So it's very hard to underwrite, right? It's a new sector or new industry that exists in the context of AI today. Not the idea of cloud computing, obviously, but specifically, these formations designed ground up from AI, and it's a it's a new sector in a new booming industry. So does that mean it is temporary and the industry kind of solves around it, or that it gets these sort of levered tailwinds because it happened to be this new product that came out at the right time, right place, and fundamentally rewrites the rules of how this industry computes? Far too early to tell, but neoclouds have been in my mind as a extreme curiosity. I do not know how to underwrite them yet, so I'm really curious as we dive in a little more here. Your second
Mm-hmm.
trend, far less exciting, but perhaps a lot more stable and reliable. That is the power bottleneck. And one of the things that I'll add here, we've talked a lot about the 5 gigawatt announcements from Meta. They're not the only ones building these massive data centers. The power needs for AI are enormous. So what are you seeing?
Oh, come on, Austin. Who doesn't get romantic about gas turbines? No,
One of the things I also love about this trend, though, is that the power bottleneck, it is a global
yeah.
bottleneck. You and I were looking at energy consumption per capita by major nations, including China, which is still, I think, a third of the US level, despite producing more electricity than the US. There's also the boom in EVs that can drive some sort of subsets of the power bottleneck grid build out necessity. So the power sector right now actually is quite interesting, despite my underhanded comments there. But let's talk about what you're seeing.
Gonna ask me if I own options in Marvell next? What is going on here, Austin? No,
I see into your soul, Eric.
yeah, the opportunity, like you said, it's global. It's also a particular one to the United States that for the 3 decades after World War II, 1945 to 1975, we were doubling power. We were doubling our grid every 10 years. And then from 1975 on, it essentially stopped. And there's a huge game right now of catch up driven by AI. But, there's also other trends like this movement of reshoring. A lot of manufacturing and other critical industries is another driver towards this. So the most obvious idea in this space is a stock like GE Vernova. We've talked about them. They are the 800-pound gorilla in gas turbines. Their stock results are staggering, Austin. They're up 92% this year, 274% the past year. And the reason for that is all the companies in this space are seeing incredible, what you call operating leverage. They're growing their revenue by 9%. They're growing their EPS by 64%. It's the same story as companies like Vertiv, where a lot of these new products going into data centers have entirely new margin profiles. So they're going to grow earnings a lot faster than revenue. So I've made some purchases in this space. I just wanted to talk about them. I think American Superconductor, which is a stock I purchased on March 25th, it's trading for $21. It was trading when I bought it for $21.22 per share. As of this morning, I'm looking at right now, it's trading for about $52. So that's a significant run up. But again, if we are seeing a sell-off in kind of risk assets, it might be something we can consider adding to the portfolio, probably at that $5,000 level in coming episodes. And what they do is they specialize in high temperature superconductors, which is the acronym HTS. And HTS is very efficient. It has high reliability. Well, Austin, what do data centers want? They want 100% uptime. So if they can get solutions in their power supply that guarantee that or give it far more assurances, that's what they're going to go for. So, this company has growth targets from Wall Street in the coming years that are relatively modest, and they just blew out earnings this week. I think they were up 30% the day after earnings. So this is a really interesting supply chain play. I had found this from, what was it? It was Citrini, which is a investing newsletter, really interesting. So I appreciate the research they had done into that. And I think this is a very compelling idea. Another stock that I had purchased, and this one's getting even more speculative, is Power Solutions International. If you go to their website, it's like, who knows what's going on? It's got that they're a division of some Chinese company, and there's a lot of things that haven't been updated since 2021. But what I had noticed before purchasing them was Grok. They had built a data center in Memphis, and they were trying to get basically they were trying to power the thing. And what they did was they were rushing a bunch of engines into the data center to power it. I said, what are the kinds of companies that can supply this? I came across Power Solutions as a company that meets this kind of use case. I think a lot of other data center providers are going to be running into. Its shares have run up since I bought on March 25th from $31 to $90 per share. When I had first looked at it, again, this story where revenue is growing at a much smaller rate, but EPS is surging. They had seen in the prior quarter 167% revenue growth. So, Austin, is this company for the long term going to be one that I want to hold on to for 10 years? Probably not. But if a lot of people are still underestimating the need for Power Solutions product, I think that they can continue playing this escalating EPS game, and they're not horribly overpriced. So, that's another stock that just when you're looking, you look at the biggest stocks like the GE Vernova, and then you can look down. There are some small plays that are really interesting for investors in these spaces, especially if we see a risk sell-off where some of these stocks come back. It might be something investors want to consider.
I love that. And Eric, on to trend three, my personal favorite. Our listeners can probably guess this based on my prior enthusiasm, and you had alluded a little bit to Amazon having a lot of potential here. But robotics. I am excited for AI to make its way into the 3D real world that we operate in so that I don't have to fold my laundry or go get my groceries or other very benign chores, although it will do significantly more than that. I want the self-driving. I want everything. So talk to me about trend three, robotics.
Yeah. So when it comes to robotics, as I've talked about, there is some difficulty in finding great supply chain plays because we don't know how long it's going to take to get towards a future where robotics are material in terms of their revenue generation. And also, there's a problem that a lot of these companies have a main end market of the automotive industry, and that continues to be in the bottom of a cycle. The semiconductor stocks that did the worst this earnings season were NXP Semiconductor, Texas Instruments, Qualcomm, which all have high exposure to automotive. So when you look at stocks not enjoying the AI boom in semiconductors, it's primarily these stocks that have automotive exposure that also are the companies that probably benefit the most from robotics. So Ouster, which is ticker symbol OUST, is a company I've been kind of researching, and they're a leader in LiDAR. We've all heard about LiDAR because back in self-driving cars, this was a technology that everyone wanted a piece of. We saw a lot of SPACs happening in 2021 to cash into it. I believe Ouster had gone public around the same time. There is a lot of excitement, but you have a problem with self-driving cars that Tesla is pushing towards a solution of not using LiDAR, and they are using cameras. So that kind of ruined a lot of the buzz, so to say, in the industry. But robots are almost certainly going to need a lot of LiDAR technology. So it gives this another kind of catalyst head into the future. When I look at the available investing options, I just kind of look at every company claims they have differentiated technology. So what ones are actually delivering the most and seem to be executing in this kind of bottom of the trough environment? And I believe Ouster is the one that is executing the best. They're expected to have revenue of $144 billion this year, 196%. This is Wall Street expectations. And
sorry, Eric, I think it was 144 million.
oh, sorry, did I say billion? Yes, 144 million. God, they would be a super buy.
That would be a wonderful buy at a $1.2 billion market cap.
Retired.
Talk about call options.
Yeah, 144 up to 196, and here I've got the number for 2027, 290 million. Against a $1.2 billion market capitalization. They're going to be losing money across that time, but they seem to be a company that's executing on the growth. So Austin, when I'm looking at plays that we can buy to start getting the exposure for robotics, this is one that is at the top of my research list right now. It's small. It's probably something that's going to be close to a zero, or it's going to be a 10x across the next 5 years. And that's exactly, the profile that you position, kind of a 1%. And you get a portfolio full of those to buffer the losers with some of the winners, and ultimately you profit from the trend, or at least you hope to. So that is hunt for the next great YOLO. 3 thematic areas we're looking at, and I guess 4 stocks total. I don't know if you have any follow-ons, or if we should just get to some listener questions and wrap this podcast up.
Yeah, Eric, this is a marathon session. I actually want to check with you because we're at about 55 minutes here, which is on the outer limit of our podcast time. I wanted to propose we call this episode a wrap, and we actually just film a follow-on with listener questions so that people can break up the episode into 2. What do you think?
That sounds great to me. My one thing I would say, I said in the last podcast, but we are publishing a lot more into our YouTube channel. I hope everyone out there can go to 24/7 Wall Street. We will put these questions on our YouTube channel. We'll continue putting more content there. And the other thing as well, just please, I'll make this appeal. I'll limit it to maybe once a month. If you're enjoying the show, we've seen a lot of new listeners, especially on Spotify recently. Just leave a review. We need to get on the right side of the algorithm. That's what it is in this game with podcasts. And whenever anyone leaves a review and enjoys the show, it helps us tremendously. And, we don't put ads. It's for the time being all that we ask, and would really appreciate if you are enjoying the show and haven't reviewed it yet, just take the 1 or 2 minutes, give it 5 stars, a nice comment, 5 stars, hopefully. And, that is all we ask in return for kind of the research we do on a week-by-week basis.
Well, Eric, thank you for that note. And I will just reiterate for our listeners' benefit, I see how hard you work to put these episodes together. It takes a tremendous amount of your time. You put your own capital on the table here, and we really would appreciate that engagement and that feedback. And we are also continuing to invest in this podcast, and check us out on YouTube, where we're going to be publishing longer video clips here in the weeks ahead. We've made some investments by bringing on some additional editing talent there, so you can see Eric in all of his glory in his home office, and me as I migrate from office to office. But Eric, thank you so much for your thoughts today. I want to close this up under an hour, and we're going to come in under the buzzer here. To our listeners, stay tuned and pay attention to our feed, because we will be releasing a follow-on episode with our listener questions and a bit of an AMA next. So Eric, until next time, thank you so much.
The AI Investor Podcast is for educational purposes only and should not be considered investment advice.